Welcome to the Kimberlite webinar that take a comprehensive look at the big four oilfield service suppliers, including a deep dive into the Permian Basin and the Middle East. My name is David Batt, president of Kimberlite Research, and I'm glad you can join us here today. I'm accompanied by Andrew Thornton with Kimberlite Research, and together we'll take you through our 37th Kimberlite webinar hosted on behalf of the oil and gas operators who participate in our industry research. Our past webinars have included many of the most commonly used oilfield services, including directional drilling services, hydraulic fracturing, artificial lift, formation evaluation, cementing wellheads, and subsea. If you or your colleagues would like access to the prior webinars, just please reach out to us, the email or chat box, and let us know. Today, we'll be taking a deep dive into the supplier performance of the big four oilfield service suppliers, both globally as well as in the Permian Basin and the Middle East. Today, we'll assess how the big four stack up vis-a-vis against each other, including some of the smaller specialty suppliers. They're a little bit less familiar with Kimberlite Research. I'll provide a brief background, and then we can dive in to the webinar today. Each year, Kimberlite conducts about 3,000 interviews of users of oilfield services. Over the last several years, we've interviewed over 19,000 users of oilfield services, and the findings and research that we'll be sharing with you today and the trends are based on the interviews with these over 19,000 users of oilfield services and over 800,000 supplier performance review ratings. Our research crosses the oilfield service community, including formation evaluation, drilling, subsea, completion, production. We also have an industry benchmark report for pipeline integrity services. The data set's fairly rich and multidimensional. In this exhibit, we will be cross-plotting oilfield service company performance on the horizontal x-axis versus their pricing competitiveness or pricing strategy on the y-axis. Based on customer reviews of the users of oilfield services, any oilfield service provider that plots in the top right is viewed as a premium supplier, costs more but worth it. Bottom left, a discount provider, maybe not performing at industry performance levels, but delivering good value based on pricing attractiveness and well within the fair value fairway. Any oilfield service supplier in the bottom right is viewed as being competitively advantaged, positioned to grow share and to grow their business, including perhaps margin. And any oilfield service company provider that plots in the top left based on customer reviews is having their value proposition challenged in the eyes of the end users and has the opportunity to either improve performance or perhaps rethink about their pricing strategies. For the many oil and gas operators attending today's webinar, I know you have many choices, and we'll be sharing with you how many choices you have in this very competitive landscape for oilfield services. Any oilfield service provider that plots in the top right-hand quadrant is viewed as a premium supplier, costs more but worth it. Bottom left, discount provider, performs below industry average, but has attractive pricing to where it's still in the fair value fairway and viewed as delivering good value. Effectively, get what you pay for. Bottom right, value advantaged. In any oilfield service company provider that plots in the top left-hand quadrant, based on customer reviews, it exhibits some vulnerabilities and needs to either improve performance or maybe rethink their pricing strategy, become more aligned with fair value in the market. So with that, we'll go ahead and dive in and take a look at what we have to share with you today. Andrew, as we kick off this new year, what can you tell us about the markets, and in particular, any thoughts about 24 drilling projections or even pricing trends?
Sure. Thank you very much, David. So I always like to start when I talk about the market at a macro level. So let's just look at demand, which is liquids consumption, as we see here. The major agencies, EIA, IEA, OPEC, they have variations in terms of how much production is going to be required. But what we can see clearly is that every single one of them anticipates some degree of growth. Now, where's that growth going to come from? So we just talked about demand. Where's supply going to come from? Despite the differences in the outlooks, I think all of the major agencies are kind of consolidating around where that growth is going to come from. We see here very clearly the US, led by the shale market, is going to drive a lot of the growth into 2024. I would say that that growth is decelerating, but it's still growing. And I think that's important. Some people say, well, it's going to decline. No, it's just we're seeing that growth rate kind of flatten out a little bit. Brazil, Guyana, the major offshore plays, they're going to have significant growth anticipated. Now, you'll notice the big red here is OPEC. Well, why is that? Well, this is an interesting visual from OPEC themselves in terms of liquids production. You can see non-OPEC production continuing to grow through 22, and then we've got this per quarter in 2023. And then look at what OPEC has done effectively over the past 3 quarters. They've purposely curtailed their production volumes in order to accommodate this growth in the market. Now, a big question, obviously, how long are they going to continue to do that? I think those of us with memories back to 2014, 2015 know that only lasted so long. I think there are some different factors here which suggest they'll probably keep at this strategy, but the market shouldn't necessarily anticipate OPEC to keep this going down. They're going to, at the very least, probably hold it flat at some point. Now, in terms of how that translates to drilling projections, we can see clearly that the world is continuing to grow. We're looking at 5 to 6% growth in terms of overall activity. As we just saw, US slightly down year over year, and we'll look at the trend in just a second. The major growth coming internationally, offshore, so Guyana, Brazil, as we just discussed.
Right.
And then international land, a lot of people go, well, hang on, Andrew, you just said that OPEC is, reducing production. That's a kind of a short-term play, whereas their long-term outlook is still very, very strong. And so they're continuing to invest in their maximum sustained capacities in the Middle East, which is going to continue to fuel this growth overall. We can then see this demonstrated in expenditures. We ask a straightforward question. Do you anticipate your expenditures to increase, decrease, stay the same? Anything above 50 is going to represent growth. Below 50 is going to represent decline. And you can see the market at a 72, overall decline. North America growing expenditure-wise, because pricing plays a role as well, but the growth predominantly coming offshore and international land. Just a demonstration of how much the market has shifted over the past 12 months. There's your international rig count from Baker Hughes, continuing to increase. Here's the United States, tops out at around 780 rigs, all the way down to 620 over the past 12 months. Demonstrated very clearly here when we see, well, we had about 2 years of 30+% growth. And now we're really looking at a flat North American market from an activity standpoint. But here's a really interesting viewpoint. This is production from oil coming out of the Permian Basin since January 2007. You see this red line?
Right.
The shale revolution kicks off, and it's continuing to grow, even with rig counts now significantly lower than what they were in 2014. What's causing this? What's driving this overall? Here's a quick example here from efficiency and productivity. We're seeing drilling days down. We're seeing completion days down. We're seeing lateral lengths increasing. We're seeing stage counts increasing. So that efficiency and intensity in North America is what is being able to keep this rig count at a relatively lower stable level, but production continuing to increase.
So real quick, if you go back a slide, one more, if you don't mind. So our drilling activity is relatively flattish year on year. 23 versus 22 is expected to be relatively flattish, 24 versus 23 in terms of the number of wells drilled.
Yes.
But if you go forward now but our production's increasing.
It is. And it is because even though the wells are effectively flat, we can see their lateral length is increasing. So your total footage is increasing. Your stage count, your total stage count is increasing. And so you're able to squeeze more out of every single well. So though the well count, rig count down slightly, well count flat.
That's the proverbial accomplishing more with less.
Correct. That is exactly right. The other thing to play in here as well is an increasing use of ESPs and large ESPs as we get those more intense wells. That's increasing initial production as well overall. Now, this is actually translating, as we just talked about, drilling's kind of flat. So an index of 55, frac activity, we're looking at an index of 58 in North America land, so slight growth. But then here's your artificial lift at 71. So that investment in production and in chemicals is going to continue to increase and drive overall expenditures in North America.
That's a strong production focus by the operators.
Absolutely. And that's been I think we're getting very close to the end of the well curve on drilling and completion efficiencies, but the next kind of frontier for our North American operators is how do I improve maximum production?
This really reflects the operators while they're trying to maintain discipline in their budgets and spending. they're trying to maximize production with the assets, the wells, and the acreage that they do have.
Absolutely.
Okay.
Now, in terms of pricing, we can start to see this translated as well. Overall, for artificial lift, you're looking at a 3.5% increase in pricing expected in North America with inflation. International offshore outpacing inflation.
Mm-hmm.
And then we look at the different components of, drilling, completion, formation evaluation. Depending on where you are in that value chain, depends on where you're going to get that pricing pressure. Overall, we can see consistency that international offshore pricing is expected to remain strong. But if you're in drilling and frac, you may be feeling a little bit of pressure over the last 12 months in terms of overall pricing. If you're in cementing services, well construction, well integrity, information evaluation,
still holding up.
Still holding up overall. Now, moving us slightly away from oil and gas and a macro, let's have a quick touch on ESG. Same concept here in terms of overall sentiment. We can see that sentiment around ESG spending continues to be robust, in fact, growing slightly. But look at the variation as to where that sentiment has changed.
It's rolled over.
There you go. It's rolled over in North America land. It's still anticipated to grow, but nowhere near as much. International land and offshore. And it, interestingly enough, the ESG sentiment is very much trending with the oil and gas sentiment, right, in operations. And that's who we're talking to. And so if your activity is down in the oil and gas space, in traditional business, the sentiments tend to be following with the ESG as well. Where's that money being spent or anticipated to be spent? Really two big areas for the most part, emissions monitoring and then carbon capture and storage. Electrification also has a role to play as well. Now, I don't think we could read a newspaper today about machine learning or artificial intelligence being mentioned, so we figured we mentioned it ourselves as well.
It's all I've been hearing for the last 2 days at the World Economic Forum.
Mm-hmm. Going back a second to our talk around production and the spend in production, where are our operators anticipating to, start to amplify AI and machine learning? Production optimization, condition monitoring, and predictive analytics. So those areas are starting to coalesce around that production space. And then a final area we're looking at here is remote operations. That's certainly something internationally which has had a big impact. You think about the North Sea and you think around areas around the Middle East. But even in North America, there is an anticipation that remote operations is going to continue to play a role as we try and take people out of the line of fire. HS&E is increasingly important. So, David, that sums up the broader market, but looking more closely into the competitive landscape, how did the Big Four stacked up regionally based on customer reviews? Perhaps start with North America, as we just discussed, and then look at the international offshore markets.
Okay, let's take a look. Let's start with North America. In this exhibit, we're really looking at the revenue growth of the Big Four indexed back to the first quarter of 2021. So this graph on the left really kind of 2022, but now you see Halliburton's revenue growth begin to flatten and actually start to decline as activities are moderating, if you will, in hydraulic fracturing. If you move over to the right and you look at the index to the most recent year, the third quarter of 22, what you see Baker Hughes's revenue growth really outpacing along with SLB, because as you pointed out, in the last year, even though the number of wells drilled isn't really increasing, the production focus that you shared, and the increased use of ESPs is really starting to show up in the P&Ls of SLB and Baker Hughes here. And
just to be clear here, David, we're not looking at actual revenues. What we're looking at is effectively benchmarking against a starting point and moving forward, so we can look at them all on the same graph.
You're looking at revenue growth starting in the first quarter of 21, or revenue growth versus the third quarter of 22. And really in the last year, the revenue growth of Baker Hughes the big three, based on customer reviews in aggregate, their value propositions are being challenged principally by the mid-tier and the specialty providers. In the Permian Basin, in North America alone, we had several hundred specialty providers mentioned. In the Permian Basin alone, we had over 300 different oilfield service companies cited as being used. Wow. So from an oil company's perspective, for all the operators listening on the webinar, fortunately, you have many choices. The specialty providers make up about 73% of overall market share. When you take a look at the performance trends here in the middle chart, and you look at the industry average rating, you can see how all the performance review ratings did decline in 2022 as activity increased over 30%, and everyone was a bit over their skis, if you will, in being able to keep up. But you can see as activity is moderated into 2023, you're seeing some improvement in overall performance review ratings. You're seeing some improvement in net promoter score ratings. You're also seeing a little bit of relaxation, as you mentioned earlier, on some of the pricing. The price escalations are beginning to ease up here a little bit. When you take a look at the many specialty providers that you have on the market, granted, this is the Permian Basin graphs, well over 300 cited. You see that from an operator's perspective, there's a lot of due diligence to be performed in order to identify best value, because based on customer reviews for just mud motors and MWD, companies such as MS Directional, part of Patterson UTI, Pro Directional Lean, Scientific Drilling, Pro Directional, even for MWD, Gordon. These are all companies that are outside of the big three, big four, if you will, that are recognized in the eyes of the operators as delivering really strong value. For rotary steerables, while 80% market share is in the hands of SLB and Baker, there's a host of new entrants trying to put out their technologies and gain some inroads.
So the operators really need to be doing their homework with all of these different options out there as to what makes sense for their program, so to speak.
Exactly. I mean, some of your applications may require leading edge technology. Others may be a little bit more traditional, normal pressure, normal temperature. Maybe you could go with more of a standard type of technology and quality of service and technical support. Altera stands out for drill bits. For drilling fluids, you've got Buckeye, AES, Geo. Cementing services, you've got Big Red, Halliburton really being challenged by a host of these specialty suppliers. Some Americans, Spinnaker and Compass, for example. Cactus continues to lead predominantly in the surface wellhead market, but you have new entrants, Atlas, beginning to establish a name for themselves. You've got Encore that's been around. Obviously, Innovex and Davis Lynch and Arsenal stand out for cementing tools. Just to kind of wrap up some four more major product lines used in the Permian. You've got in hydraulic fracturing, you've got Liberty Energy, and you've got STEP. You've got Halliburton really just beautifully positioned in the Permian Basin. Halliburton for hydraulic fracturing has done an excellent job in being established in the eyes of the operators as that preeminent hydraulic fracturing service supplier. If you're really trying to push completion intensity,
as we see in the earlier graphs.
Exactly. They are viewed as a top tier performer amongst E&P operators that are drilling really long laterals, 60 plus frac stages, drilling programs of 100 plus wells. Perforating, you've got Silvertip and Dynasty, and you just see a whole host of options, including Innovex. When you look at what the operators are really looking for and how their recommendations for the use of these many, many different suppliers from which they have to choose from, we find that when it comes to drilling services, the E&P operators are really starting to lean on more heavily on service and differentiating technology. Whereas when you start to get into completion, production, and even formation evaluation, price becomes more of a stronger influence. So different operators in North America land in the Permian Basin, it's such a diverse group of operators, they have different needs. Some really value quality service, some value differentiating technology, others are just looking for an attractive price. And so depending upon what you're looking for, you can find what you need. Turning to the international land and Middle East, we see a highly differentiated competitive landscape with SLB viewed as the performance leader with a very significant market share leadership and really poised to benefit from the growth and activity that you mentioned that we expect to see in 24 and even beyond internationally and offshore. Halliburton's performance improved quite a bit year on year, and Baker's stepped back ever so slightly. But if you take a close look at Weatherford's really viewed as being one of the more value-advantaged suppliers and poised to grow in the international market. If I go interactive really quick and just kind of look at the international land market very briefly here, what we find is that Weatherford is positioned to grow and expand both revenue and market share. But if I were to go in and say, do kind of a quick head-to-head analysis of, say, Weatherford in the international land market versus that of, say, Baker Hughes, based on the customer reviews that we're receiving from the E&P operators, the performance delta between Baker Hughes and Weatherford is basically a dead heat on many key performance variables, such as technical support, responsiveness to needs, competency of field personnel and such, with Weatherford having an edge on supply chain and such. When you go and do a head-to-head of, say, Weatherford versus Baker Hughes, Halliburton, you can see that there's some tightness in performance in the eyes of the end user in technical support, responsiveness, and willingness to recommend, where Halliburton has some performance advantages here. But when you start to take a look at the customer experience dispersion levels, what you notice is in international land, Baker Hughes has a broad dispersion of customer experience that the E&P operators internationally are receiving from Baker Hughes, as well as for Halliburton. And Halliburton's had some really good success in moving pricing up internationally year on year on many situations, but it's creating an inflection point where many of these customers are beginning to challenge Halliburton's value proposition. And they'll have a couple of other options to go to. They may choose to go down to Weatherford, where customers that use Weatherford typically see Weatherford as delivering exceptional strong value and position to grow revenue and margin. Or they may want to slide over to SOB, who's considered delivering, better performance than Halliburton, but at a very similar pricing strategy. And so we clearly see some distinctions and differences taking place in the international market. And this really translates over when you see SOB as the performance leader, maintaining strong pricing discipline. And when you move into the Middle East, based on the advantage position that we see with Weatherford, if we index just revenue growth over the last year, using third quarter of 22, we see that Weatherford's revenue growth is outpacing the big three.
Significant 30% growth overall.
And this really reflects the value that the operators internationally are finding in Weatherford. When you take a look at a Middle East specific slide, again, you see the very strong differentiated value where SLB is positioned as the premium-based supplier. Again, Weatherford poised to grow, as I was sharing with you earlier on that. And Weatherford's been improving their pricing discipline and positioning. When you move offshore, again, what we find is Halliburton's performance has improved year on year and beginning to challenge SLB a little bit more in the offshore market. Baker Hughes' performance still well aligned with operator expectations, did slide back slightly relative to SLB and to Halliburton. But again, we find Weatherford here well positioned for growth and viewed as delivering strong value. So if I go back to the value map, but I move from international to offshore, what we find is Weatherford well positioned to grow. And if we do a quick head-to-head again of, say, Weatherford versus Baker Hughes, we'll see that based on the customer reviews of the offshore E&P operators, the performance feedback, again, is very tight between Weatherford and Baker Hughes. Baker Hughes and Halliburton both are providing a dispersion of customer experience levels. Halliburton has a dispersion of customer experience levels as well. And again, these operators that are challenging the customer experience and the results of some of the suppliers have options. Some of their options may come down to Weatherford or slide over to SOB. And so when you look at that and you start to sum this up kind of on a global level
basis,
we're not surprised to see that over the last year, the strong growth that both Weatherford and Baker have been presenting due to the production solutions focus, but also with the value advantage positioning of Weatherford. In fact, if you look at the EBITDA growth, Weatherford indexed back to the first quarter of 21 has seen their EBITDA expand by 1,100 basis points and is now challenging the leader, SLB, who has 25% EBITDA. Weatherford's at 23, followed by, I believe, Halliburton at 22%. And so it wouldn't be surprising as Weatherford continues to execute and grow both in revenue and share and margin to have margins that are on par with SLB. and potentially perhaps even surpass. One of the biggest changes that we see amongst the major oil companies is back during the COVID year, the major oil companies really focused on procurement and technology, differentiating technology back during the major down cycle of 2020. But as the market began to rebound, what we noticed was that the major oil companies began to realize that having access to quality service becomes even more important. And now that activity levels have moderated somewhat on a global basis, but not so much internationally and offshore, they have much more of a normalized position.
Well, that really shows you need to be, paying attention to what it is that drives your clients and offering the right thing to them. If you're all focused on technology and that's really a small component of the market,
right?
Versus say more service offering, that could, you may be doing a great job in the wrong area.
Exactly. So from an oil company operator's perspective, depending upon your needs for your project, you have many options to choose from. Globally, there were just under 1,000 different oilfield service company suppliers cited as being used globally. In the Permian Basin, it was about 350 different suppliers cited as being used. What's interesting here, Andrew, is these large independents that are heavily North America land focused that are driving these drilling intensity, completion intensity improvements. They're really leaning on differentiating technology, be it bottom hole assemblies or completion technologies, be it simultaneous hydraulic fracturing, dual fuels, and improved bottom hole assemblies to be able to drill the laterals without pulling out of the hole.
And that's interesting, David, because we often hear the comment, well, North America is just completely commoditized and price driven. Is there anything in the data that really suggests that?
There's truly no evidence for that. It's true you need to be price competitive. It's true that the oil companies are going to hold the oilfield service companies somewhat accountable, not to get too much out of whack on pricing vis-a-vis each other. But the tiebreakers are typically going to be service driven or technology driven.
Well, especially when you're pushing the limits on lateral lengths and intensities and all of those kind of things, you can't really do that without good service and good technology.
Agreed. Well, Andrew, why don't we take a closer look at each of the major oilfield service suppliers and perhaps maybe delve in a bit more deeply on their strengths and weaknesses, perhaps even at the product line level, because I was just kind of covering this at a higher regional level.
Yep, absolutely. So let's go alphabetically and let's start with Baker Hughes.
Okay.
From a geographic perspective, you can see Baker is actually well positioned internationally and offshore. Very well positioned in Latin America, so the growth in Brazil, Guyana potentially could be advantageous for them. They are being challenged somewhat in US land and Canada, as are all of the big four, really. Right. And we'll have a look at that in a second as to what's driving that overall. If we dig into the product lines, and we just mentioned North America, despite the growth in production, you can see that their chemicals business has got a bit of a challenge over here, and it's a significant portion of their portfolio, as is Subsea, which is kind of dragging them off and to the left a little bit, but very well valued in bits, historically, a strong part of Baker Hughes, part of the name, ESPs, as well as some of their drilling businesses as well.
Even completions.
Even completions as well. And when we go to internationally and we look at the Middle East and we talk about completions, see there's safety valves popping up and intervention. Again, their drilling businesses, very well positioned, as is the ESP and artificial lift. Some challenges in liner hangers and packers. So a little bit of dispersion that they need to focus in upon overall.
Pretty good. That's pretty good alignment.
But it's a good alignment, right? Exactly. And we'll see in just a second just how much they've been able to get more consistency on that.
Right.
Here's the Permian. Similar story overall. You can see those key product lines: drill bits, drilling services, artificial lift, packers. Again, part of Baker Hughes's legacy with Baker Oil Tools.
Yep.
Significant premium provider, but some challenges. There's that production chemical, which is kind of dragging them off into the left a little bit. Liner hangers, performance pretty much in line with the market, but see the a little bit higher than. Yeah, so kudos to Baker for getting more consistency. Are there dispersions? Of course, that's still occurring.
And these are by product lines, right?
Yeah.
Okay, that's pretty good. They're improving.
Now here's Halliburton, big red. Similar story overall. Internationally, very well positioned, delivering strong value to their clients. Well positioned in Latin America, Canada, and US land, particularly with those other players that make up, 70% of the market,
Right.
really creating some points of differentiation. In terms of those products and services, you see it shifting up and to the left just a little bit, but overall, we've got some great product lines here. Liner hangers, cementing, right in the fair value fairway. ESPs, very well valued on a global basis, so they're continuing to grow that market.
ESP looks strong.
Strong. But motors, cementing tools, and even frac a little bit on a worldwide basis, something they may just want to pay some attention to. Now we flip that to the Permian. You see frac just moves straight across here. So that premium provider, as we talked about the lateral lengths earlier, right? ESPs well positioned. Where are they being challenged? Again, cementing tools, drill bits, some of the NWD as well. So on the drilling well construction side of the house, potentially some areas to dig into.
Particularly with cementing and drilling fluids, because those are historically been really strong product lines for Halliburton.
They have historically. Now, one thing I will say here is that Halliburton's been quite vocal over the past, 10 years about its,
right.
I mean, historically, I think they call them fairway players, and they're focusing in on certain customers. If you focus in on those, let's say those big operators with 100+ well programs and so on and so forth, this does tend to drift back towards the center ground, but they may be just getting a little bit of a kick from some of those smaller players saying, hey, we'd like some attention from you as well. Thank you very much. Moving to the Middle East, it's a strong dispersion pattern. They're well consistent, but we can see frac, well positioned, liner hangers, that market is growing, and packers. But again, in the drilling side of the house, now ESPs, as we saw earlier, North America doing very well. Not so strong in the Middle East market from our data. So that's one area from a consistency standpoint, if they want to grow with the market, that they will want to focus in upon.
They're still early days internationally with ESPs. So we'll have to wait and see how that plays out.
They're cutting their teeth. They're learning what they're learning.
Same thing with the chemicals. That's a new area. It's a major area of investment for Halliburton.
Yep.
And that'd be one to monitor closely to see how that investment plays out. I noticed the wireline logging internationally has starting to reach an inflection point, whereas before it was historically always viewed. And I think that's a result of some of those year-on-year price increases that they've done a great job in.
And I think historically we've seen that kind of drift upwards if we were to look at this from a year-over-year perspective. Similar to Baker in terms of that consistency, again, large dispersion patterns in 2020, a little bit all over the map. And look how much that's tightened up offshore and internationally as Halliburton's been very vocal and focused in on those areas. So it's been able to deliver consistency with performance. North America, that dispersion pattern does still exist. And so that's one area to have a look at. Now, SLB, strong in the top right-hand corner as the premium offit. They are the largest oilfield services company in the world for a reason. They've got that premium brand image. Canada, US, we talked about that one in terms of the big four, always seem to be plotting in this top left-hand quadrant, but North Sea, Asia, Middle East, West Africa, offshore markets, well-positioned overall. And again, look at that consistency of the product lines. Very few actually sitting in the value disadvantage PCP, but their core offerings around wireline, around well construction, all sitting in a premium position. Now, as we turn to the Middle East, similar story, and that's really this. We're going to see a similar vein here with SLB. It is that consistency, overall, is that everything is drifting into that top right-hand quadrant. Which then permeates an even stronger brand image, and it tends to just reinforce itself at that point in time.
And that's a key attribute, because I know many of the operators that we talk to emphasize the desire to have consistent performance from job to job and from product line to product line within these integrated providers. So that's really a huge strength for SLB.
Absolutely, that you're going to get a very similar performance and a similar expectation every time they come out to the well site and those coveralls. Now, Permian, a little different. North America, the wellheads business, well positioned. ESPs, small part of their portfolio, but certainly doing well. But some of the well construction components in MWD, mud motors, and RSS just drifting up into the top left here. So something to pay attention to is that the performance isn't that far away from the market, but pricing is seen as pretty aggressive overall. And then we talk about that consistency. you can see actually they've had that for a number of years, and they're starting to reinforce that upon year. Now, finally, Weatherford, last one we'll look at here. As you mentioned earlier, David, well positioned overall. There is nothing that sits outside of the fair value fairway or in a value kind of advantage position. Really, if you are above this line diagonally, that's where you start to want to pay attention. Everything is in a very well valued position, so delivering strong performance in alignment with quite a lot of value.
That supports the financials shared earlier with their revenue growth and margin growth.
And they've been able to grow significantly off the back of this. We look at these product lines, everything's sitting right here, able to potentially, grow even further. There is a outlier, which is their rod lift business, and you'll see that in the Permian as well. They're being challenged a lot by a lot of local suppliers. It's a highly competitive, highly fragmented market. So that's one area in North America in particular that the company will just want to pay a little bit more attention to. But if you look at some of the strengths, cementing tools, a key part of the portfolio, completion tools, all very well positioned. Similarly, in the Middle East, that growth market, very similar profile. Weatherford a little bit more internationally focused with those completion tools. Rod lift sits out there as the outlier. And then within the Permian, a smaller portfolio, well positioned with liner hangers, packers, and intervention services. And then we talked about rod lift. So David, that's kind of the big four. And to wrap things up, how do you see 2024 shaping up for the oil and gas industry? And what upcoming market updates and webinars do we have?
Sure. I mean, as we kind of look into 2024, and I see we have a question that just came in about the E&P operator consolidation, and that's one of the things that we've been tracking. We've noticed all this E&P consolidation taking place, and we expect that to continue. I think the impact to the oilfield service community with the consolidations is these operators, as they consolidate, they'll be keenly interested in driving drilling, completion, and production efficiency and intensity to the next level. So I think oilfield service companies that have differentiating technology and capabilities will actually perhaps benefit from the operator consolidation. I do think we need more oilfield service company consolidation as well, Andrew, because we really don't need 1,000 different choices for oilfield services globally.
No.
Okay. Other trends for 24, fortunately or unfortunately, the volatility will continue, so we have no control over that. But we see really good discipline on behalf of operators and service companies to really focus on good performance and operational execution and capital discipline, focusing on shareholder returns over growth for growth's sake. And that's kind of important because in the near term, OPEC cohesion is needed on the supply side as these economies around the world start to pick up and recover in terms of demand growth, which we all see coming. And so, there's going to be a delicate, tight balance there. The other trend that we see, investments in digital. I know you touched on it with AI, ML. Like I said, it's kind of hard to go through the days today, predominantly around production optimization and drilling optimization. And so that's an area that we'll continue to see. And then I think energy literacy will continue to improve as we get into 24 and 25. It'll be interesting to see how the elections and the outcome of the elections in November kind of change the trajectory of the spend on some of this new energy stuff. But and then in terms of upcoming reports, we just published our updates on cementing, wellheads, and liner hangers. We'll have a webinar for the oil and gas operators on January 31st. So please be on the lookout, mark your calendars for that. In about a week or two, we'll be publishing updates on completion equipment and services, including strong coverage for packers, sand control, permanent downhole monitoring, intelligent completions. There's that digital theme again. And so we'll probably have some webinars coming out in February. So stay tuned for how we get those and set those dates. I guess we'll also be publishing updates on subsea, and we'll be publishing updates on subsea as well as G&G software. And in the G&G software, we'll be covering a lot of the digital updates, regardless if it's cloud-based adoption or OSDU and things of that nature in April. In terms of another question came in on current rig scenario in the Permian Basin. Did you have a slide on rig count in here or not?
Not on this one, not in the Permian specifically. I mean, I'll talk to it a little bit. I think, we've seen the rig count overall bottom. broadly speaking, and it's bumping around there, and we see 1 or 2 rigs every single week up or down from the rig count from Baker Hughes. When we actually look at the change that the US one we saw earlier, way up the top of the presentation there, in terms of the decline in the rig count, there we go. If the US was down around 20%, the Permian was actually more like 15%. So it held up a little bit better. Some of the private E&Ps obviously were the ones who reduced first. I think there's a couple of things that are Permian. Overall, it's probably going to stay relatively steady from current levels, with the exception of some of those transactions around ExxonMobil, Pioneer. Hess isn't in the Permian, but Chevron, Oxy and Crown. What we're seeing is like 1 and 1 actually equals 1.5 when it comes to rigs with these consolidations. So we may see the Permian rig count decline a little bit further, but in terms of the well count and the productivity, and that's an area I'd be focusing in upon. Right. We don't see that, declining, shall we say.
Sure. So I know for anyone that's interested, please reach out. We do have our current rig forecast. We just didn't cover it in today's webinar, but generally speaking, rig counts will modestly increase going into 24, but on a year-on-year basis, rig count may be flat or down a few points. And the real key to watch for rig count is this production graph. As long as we're producing more oil and gas and getting more out of each well that we drill, because we're drilling longer laterals, completing more frac stages, using larger ESPs for longer periods of time. As I just mentioned, OPEC cohesion is very critically important. The last thing that we need to be doing is stepping on the accelerator for supply growth in a market that's being temporarily challenged on the demand side. The demand's coming. IEA, EIA, OPEC, everyone's forecasting increasing demand.
Yep.
Exxon, all the major forecasters that they're looking at the forward view see increasing demand. But there's some temporary softness that we need to pay attention to. And so, it's going to be a healthy year, okay? But the days of 30% year-on-year growth in the United States land market are probably not going to happen again for a while. Not unless there's some macroeconomic upset like we had in COVID, where we have artificial downturns that are so deep that you have these deep cycles, or these super volatile cycles, if you will.
Yep, just like this.
So but that's a great question. Please feel free to reach out. Any other questions before we wrap here? Okay, all clear. So I tell you what, be on the lookout for January 31st for the webinar for wellheads and cementing and liner hangers. Be on the lookout in February for updates on completion equipment and services, packers, sand control, permanent downhole monitoring, and intelligent completions. For anyone that's looking for updates on digital, ESG, new energy investment, we're tracking that as well. We can only give so much coverage there in these webinars. So please feel free to reach out to discuss topics of interest to you. And thank you for being with us today. Have a great rest of your week. Bye now.